we're very, very happy to have him, and we want to thank him for joining us. Actually, in a different point is that we are actually giving him an awards. This is called the Distinguished Leadership and Service Award for Sustained Contribution to the Global Economy. Anybody who knows Ravi knows nobody deserves this award more than he does. He will soon be stepping down as the managing director of the Monetary Authority of Singapore. And during his service in Singapore, he's over 30 years where he's worked on issues from international trade, international finance, to global economic issues. For the last dozen years, he's been the managing director for the Monetary Authority of Singapore and a true global leader, whether it's in the FBS or the Financial Stability Board or where have you. Let me just point three things, and then I want to turn it over to Ravi. One is he was one of the key leaders in trying to think about digital finance. In fact, actually, he is the person who taught me the word regulatory sandbox. I didn't know what it was. And he actually explained it to me about how they were trying to do this in Singapore. Second is and he still is the chair of what's called the NGFS, the Network for Green Financial System. And that's a group of central bankers that basically is trying to think through the issues of sustainable finance in the financial system, and Ravi chairs that. And third, and Ravi, I doubt, remembers this, but roughly 10 years ago, maybe a little less, he and I were having a conversation about global financial regulatory issues. And this was in the context of after the global financial crisis and Dodd-Frank. And he said, we're very, very focused on getting the regulations correct, but I do worry about whether or not we're getting financial supervision correct. And that couldn't have been a more prophetic thought, as we've seen what's happened. Tim Adams earlier today talked about all the different reports that have come out on the failure of Silicon Valley Bank, Credit Suisse, and what have you. And almost every one of those reports talks about the problem of financial supervision. And Ravi basically was telling me about this 10 years before it all happened. And so it'll be interesting to hear some of his insights on financial supervision. Why is it that we don't seem to always be able to get it correct? Are there technological solutions that we could actually be using that could do a better job? Hopefully he'll be able to address some of those issues. But without further ado, and I'm not sure, Ravi, if you can see this or not, this is the Distinguished Leadership and Service Award, and we're very glad that we're able to give this to you. My CEO, Tim Adams, will be in Singapore in November, and he'll bring you the actual award when he goes, and it'll be a heavy part of his luggage. So in the meantime, though, Ravi, thank you very much for doing this. Thank you very much for all of your service to your country, but also to the world. And let me turn it over to you now.
Thank you, Clay. Thank you very much for your overly generous remarks and your great memory going back 10 years. I must confess I have no recollection of that conversation, though I know we've had very interesting discussions over the years. So thank you very much. Ladies and gentlemen, a very good morning to everyone in Morocco. Greetings to everyone else attending virtually. And I'm delighted to join you, unfortunately virtually, at this IIF annual membership meeting. I really wished I could have come. I had to cancel my trip due to circumstances back home. I'm really honored and humbled to receive the IIF's Distinguished Leadership and Service Award. Honored because of the high standing that the IIF enjoys as the leading global association for the financial industry. And humbled because I know how much I owe this award to my colleagues at the Monetary Authority of Singapore, my counterparts in the international regulatory community, and the leaders of the financial industry in Singapore and elsewhere. I've been fortunate to witness the evolution of the financial industry and its regulation over the last 3 decades in my own country and globally. crisis has taught us to become more resilient and better at managing risks. Technology has enabled us to become more innovative and inclusive. Policy reforms have paved the way for us to become more global as an industry, though some of this progress is under threat today. And rising affluence, especially in the emerging world, has given us new opportunities for growth. So it has not been bad for the financial industry. I do think we are getting better as an industry. There is one critical task, though, that remains undone. In fact, I think it will be the ultimate test of how much of a force for good the financial industry will be. Yes, I'm talking about the climate crisis and what finance can do about it. And today I want to focus over the next few minutes on what I regard as the single most important goal that the financial industry can support to help achieve net zero globally. And that is the energy transition in emerging economies. And I would add, especially in Asia. The world is not likely to reach net zero emissions by 2050 without a successful energy transition in Asia. The issues of transition are most acute in Asia. Asia accounts for 50% of global greenhouse gas emissions. Coal-fired power plants alone account for a third of Asia's greenhouse gas emissions. Now, if these coal plants are left to operate as planned, they will exhaust 2/3 of the carbon budget that we have remaining to keep the rise in global temperatures to within 1.5 degrees Celsius. So if we can successfully manage Asia's energy transition, it will go a long way in contributing to a net zero world. But phasing out coal in Asia is hugely challenging. First, the scale. Coal accounts for nearly 60% of power generation in the region. And Asia's energy demand is projected to increase by 2.5 times by 2050 on the back of economic development, population growth, urbanization, and the need to bring electricity to poor people in far-off villages. Second challenge, the jobs. The coal economy is a key source of employment in Asia. According to estimates by the International Energy Agency, more than 80% of the 8.4 million employed globally across the coal value chain is concentrated in Asia. Third, the age. Asia's coal plants are young, less than 15 years old on average. And this makes the economics of phasing out coal more challenging, especially as new coal plants continue to be built to keep pace with energy demand. So we need an energy strategy that will phase out coal in a progressive manner, switch to cleaner transition fuels like natural gas, and accelerate investments in renewable energy. Specifically, we need a coherent strategy for the managed phase-out of coal by encouraging owners to wind down their coal plants ahead of their technical end of life. And this strategy would rest on 3 key success factors: credibility, viability, and justness. To be credible, phase-out plans must be aligned with science-based 1.5 degrees Celsius pathways. And standard setters and international experts like the International Energy Agency have a key role in setting out these pathways. We also need specifics, such as metrics, to measure positive climate impact and interim milestones to indicate that the phase-out is on track. We also need safeguards to minimize leakage, namely the risk that other coal plants or new coal plants are used to replace the energy that the retired coal plant used to generate. Now, some good work is being done to help shape credible phase-out plans for coal through expert guidance and taxonomies. The GFANZ Asia Pacific Network has launched a consultation on draft guidance on the managed phase-out of coal plants. Now, this guidance can help align how financial institutions can collectively drive a credible, impactful, and inclusive phase-out. The ASEAN and Singapore Asia taxonomies provide clarity on how coal-related activities will be classified. These can serve additional reference points for financial institutions to assess whether the coal plants are on track to be phased out. I'm glad to note that MAS has been deeply involved in both the GFANZ guidance work and the taxonomy work. Second success factor, the managed phase out of coal must be economically viable. So MAS is taking a crack at this through two key initiatives, blended finance and transition credits. Blended finance can be a powerful tool to de-risk climate investments, particularly for transition projects that are marginally bankable. Basically, this is to use catalytic and concessional capital from the public sector, multilateral development banks, and philanthropic sources to reduce project risk and enhance project bankability, which will in turn crowd in multiples of private capital. Now, there have been a few successful bespoke blended finance transactions, but they have thus far not been employed at scale. Singapore is currently developing a blended finance platform to help scale up financing for Asia's green and transition infrastructure. A common platform will help bring together technical assistance, governance arrangements, and a capital structure that caters to different risk appetites and return objectives. Singapore is keen to work with like-minded partners internationally to develop blended finance and support Asia's net zero transition. Philanthropic capital can potentially play a transformative role in crowding in multiples of private sector capital. Philanthropic capital is well suited to underwrite risks that the private sector cannot, to co-invest in projects where the private returns are low, but the expected social returns are high. McKinsey has estimated that $300 billion of public and philanthropic capital can mobilize $900 billion of total capital. Now, this could potentially address 40% of the net zero financing gap that exists in the Asia Pacific today. Yet, less than 2% of philanthropic capital globally actually goes into climate finance. MAS looks forward to working with the financial industry to better harness the wealth of foundations, family offices, and high net worth individuals for blended finance projects. Blended finance aside, MAS is exploring the idea of what we call transition credits. MAS and McKinsey launched a working paper last month on this concept. The idea is to generate transition credits from future emissions reduced through retiring a coal plant early and replacing it with cleaner energy sources. The additional revenue from selling the credits could significantly improve the economic viability and align the interests of coal plant owners and capital providers. Transition credits must be of high integrity to generate trust and confidence. High integrity means the host jurisdiction needs to commit to not build new coal plants. There should also be replacement with cleaner energy sources to minimize the need to restart a retired coal plant. Transition credits must be aligned to the core carbon principles set out by the Integrity Council for the voluntary carbon market. Transition credits must meet the needs of those who buy these credits. This means addressing concerns surrounding the timing mismatch between when the transition credits will be generated and when the financing will be needed. Now, this involves exploring mechanisms that can bring forward the issuance of credits and facilitate early offtake, such as insurance solutions or advanced market commitments. Developing transition credits as a credible and viable financing solution is by no means easy. It requires strongly supportive policies and deep product and market innovation. I believe that the financial industry has the innovative capacity to make instruments like transition credits work. MAS is therefore calling for like-minded partners from the industry to work with us on pilot transactions. Basically, we have to learn this by doing it. Third success factor, we must ensure that the managed phase out of coal is implemented in a just manner. The early retirement of coal plants will disrupt lives and communities, particularly of those who rely on coal mining and related operations as a source of livelihood. A credible managed phase-out program must ensure that measures are in place to mitigate potential harm to livelihoods and communities. This means one, robust assessment of any negative impact at the plant, community, regional, and national levels. Two, mitigation measures such as workers' transition and retraining plans, and frameworks to monitor and assess the effectiveness of these measures. And three, explicit provisions to properly finance the implementation of the necessary measures. For instance, a portion of the revenue from the sale of transition credits could be set aside for reskilling displaced workers. The coal transition is fundamentally about people. Managed phase-out should be done in consultation with key affected stakeholders. Local governments play a key role, especially in providing opportunities for redeploying a large group of displaced workers and their families under a broader energy transition plan. Let me conclude. The economics of investing in climate change mitigation are attractive. The IMF has estimated that a policy mix of carbon taxes and green investment stimulus could increase global GDP by 0.7% per year through 2036 and create 12 million new jobs through 2027. Green and transition finance is potentially the next big growth story, but we need to innovate, take some risk, and work real hard to realize that potential. And I believe, and I hope, that the financial industry and international policymaking community will step up to the task. Thank you.
And thank you, Ravi. That was an excellent, some excellent points, and I loved your kind of your summation of the importance of credibility, viability, and doing all of this in a just manner. And I think that that is something we should all be striving for when we think through these issues. Let me take what you just said and put it in a little more in the international context. You've been the chair of the NGFS, which gets a lot into some of the areas that you were just discussing, but it's kind of, it takes it a step back. It's a broader, looking at disclosure standards, and recently we've had standards for disclosure through the ISSB. But maybe you can talk, what are some of the lessons that you've been learning through your this role, and also through basically talking to your fellow supervisors and regulators about how do we avoid fragmentation across jurisdictions as we look at these issues?
Yeah, so those discussions are actually occurring in earnest. As you know, there are no international standards as such, as we have with the Basel framework for sustainability. But there are many active discussions, and I think you pointed to one very important one, that's disclosure. I would put it in, there are 3 Ds we need to address to get this sorted out in a coherent manner globally. One is data, second is definitions or taxonomies, and third is disclosure. These are the key enablers for much of the financing to flow, because if you don't have good data and good measurement, if you don't have good definitions or taxonomies that are interoperable and widely accepted, and if you don't have disclosure standards that are comparable and are consistent, then you have a lot of problems. It becomes very difficult for any financial institutions to engage this on scale. So efforts are underway on all 3 of those. And you mentioned the ISSB, and we need to ensure that everyone, this is on the disclosure front, which is the most downstream of the three Ds I mentioned, to adopt it as the global standard. Even if some jurisdictions and companies in emerging markets may need to proceed at a different pace. And this is certainly better than not adopting the global standard. Thankfully, today we have the ISSB as the common global standard. Of course, the EU standard and a disclosure standard or template in the United States. That's not too many, if you ask me. And there have been great efforts to make sure that the 3 are broadly comparable, even if they have to reflect differences in priorities and jurisdictions. So the aim is not to have a single standard, which I don't think is possible, but to allow for comparability across standards so that there's no great compliance burden on reporting sustainability efforts according to these standards. And the ISSB has introduced, as you know, structural reliefs and also temporary transitional reliefs within the standards to allow for proportionality in implementation. I think when it comes to disclosure, we don't want to let the perfect be the enemy of the good. We're all starting in this. We're all not going to get it right the first time. And so I think there must be some emphasis on materiality and proportionality and best effort made with respect to making these disclosures. And over time, they will get better, just as accounting standards and financial reporting has taken about 40, 50 years to get to where it is today. Now, we don't have 40, 50 years, but I think on the sustainability disclosures, that's the way we need to go. And the last point on taxonomies. What is green? What is amber? And what is red or, brown? Here, I think there is more differentiation and fragmentation, unfortunately, because they reflect country priorities, the NDCs, and so on. Again, the effort underway among regulators is not to combine all of them into a common taxonomy, because that's not possible, but to see if we can have comparability across taxonomies so that they can talk to each other. They're interoperable. I think that is the goal of many of these efforts, to achieve not uniformity, but interoperability, so that definitions, disclosures, and data are used in one jurisdiction without too much effort. I can translate into another jurisdiction to meet a different requirement or need. So progress underway. We're not there yet, but almost everything on the climate front is still very much work in progress. But this is something that I would like to say that the global regulators are very focused on to get it right. And we have a unique opportunity to get it right because things are still nascent, and therefore early conversations can achieve a greater degree of convergence, unlike other regulations where they've developed very much domestically, and we have to try to make them comparable internationally. Thanks.
Thank you very much. And let me just wrap it up there. I just want to again thank Ravi Menon for taking the time and giving us some very, very thoughtful comments about, especially on the sustainable finance front and some of his thoughts on that. But maybe more importantly, I want to just thank him for his service for so many years at both in Singapore and at the global level on such very important issues as digital finance, sustainable finance, supervision, and so many, many more issues. So I want to just, hopefully maybe everybody, just one more round of applause, and thank you very much, Ravi Menon.
Thank you. Thank you very much. Thanks, Clay, and best wishes to everyone over there. All the best. Thank you. Bye-bye.
Thank you. Bye.